Hello, we're back into trying to understand strategic management. My name is Álvaro Cuervo, and now we are going to be discussing acquisitions. This is just one method that companies can use to renew their ability to compete, to renew sources of value creation, to renew sources of competitive advantage. Within this, we are trying to understand what are acquisitions, what are the different types that we have, how can we use acquisitions in a strategic way, and then what is the process. So let's get into these acquisitions. Well, something relatively simple. Mergers and acquisitions, merger, integration, typically the perception is equally equally sized or equally in importance companies into a new entity. Acquisition, one company takes control over another. The reality, the vast majority of acquisitions, even though we talk about merger acquisitions, M&As, they are acquisitions. A company controls the other. Yes, maybe it's just 50-50, but in many cases, what you're going to see, there is going to be a person who is going to be boss. Sometimes they have co-CEOs to some extent to deal with personalities, but the reality is that somebody is going to control, somebody is going to impose the way in which things are going to be done and decided. So with this, it's the integration of two companies, one over the other, by the other, or if you, in some cases, together, if they are perceived to be more or less equal. Different types, by attitude, hostile versus friendly. What is the meaning of this? Well, in some cases, the company buys the target and the target does not want to be acquired. Yes, thank you very much for the offer. However, we think that we are undervalued and therefore we are not going to be open to help you acquire us. Example, InBev, which is a big Belgian-Brazilian company, decided, oh, we want to continue expanding. It was already the result of an acquisition. So let's say, why don't we just go and in the US market, there is Anheuser-Busch, which is the dominant player. It would be nice to buy it and then control it. The board wasn't happy about this. They were more than happy to continue being independent, but basically through the negotiation, of course, InBev was continuing upping their offer, and eventually, yes, you cannot say no when all of a sudden there is a lot of money on the table, and as a board member, you have a duty to basically try to get the best deal for the shareholders, and they ended up being acquired. But it was basically, no, at the beginning, we don't want to be acquired. Different from friendly, in which what you're going to have is that, yes, we need each other. It might be good if the two of us are together within the same entity, and we, as a result, can integrate each other, and we agree to it. So let's be happy with it. So that why don't we go and again continue, if you want, the example of beers, in which all of a sudden, yes, we were not happy with it, but then they integrated company, Anheuser-Busch InBev, decides that with the other big beer company, why don't we go and dominate the world? So it will be good for both of us to basically achieve the scale so that we can be operational throughout the globe and to some extent benefit from economies of scale, the reach, the learning, the innovation that we can transfer around everybody, every operation. And the result was, well, they ended up being extremely dominant everywhere. Really good for them, really good if you want to achieve some degree of monopoly that then gives them, if you want, the ability to increase their value capture, profitability. Other ways of understanding acquisitions, by value chain, input output. The story that we saw, is it just horizontal or is it vertical? Is it just things coming in, going to the next stage? So we are within the industry value chain getting many more of those activities within the same company. This is a vertical acquisition. You are getting backwards into your customers, to your suppliers, you're buying them, or you're going forward into your customers. The example, 2016, the Italian Luxottica, big maker of luxury glasses, frames, although they did have some operations in the lenses, they decide, okay, this is going to be good. Why don't we get together with the French company Silor, which was at the time the biggest producer of lenses, high-end lenses. So this is going to be really good for the two of them. And then they ended up basically going backwards into lenses. Similarly, Luxottica earlier decided, well, it will be good. Yes, it's nice to produce the frames and people choose the frames and then you put the lenses to them. Why don't we get into distribution? And they decided to, in the case of the US, get into the acquisition of Pearly Vision and Sunglass Hut so that they could control distribution and basically push their products towards the final consumer. The idea here is vertical integration, different segments of the value chain. Horizontal acquisitions, you are buying another competitor. It's just a scale story rather than a control of the value chain. 2020, Fiat Chrysler, the Italo US company, and PSA, the French company, decided that, look, it's nice, we are big, but we are not quite at the level that is required nowadays to compete in the global automobile industry. It will be good to merge and integrate our operations so that we achieve the economies of scale that enable us to compete against others. It's big investments in technology, distribution, and the global reach. And that's basically what we ended up doing. And now they changed the name to Stellantis. Vertical versus horizontal acquisitions. We have the type of relatedness, product extension versus conglomerate. When there is some relationship among the products, to some extent related to vertical integration, it doesn't have to be the case. It's mostly the products can be complementary. It's going to be good to basically put them together. There is some learning, some joint development of technologies, can be good to have everything together. Google decided to get Motorola. Motorola was at the same, basically exiting smartphones, partly because of problems, some bankruptcy problems. They decide to sell the patents, and Google decides, okay, this is going to be good for us. We are getting into the smartphone industry. We might need some patents to basically have a stronger, if you want, technological base and potential defense against the patent fight. So they decided to buy that, or in the case of the case we have is, well, complementary markets. Because of InBev, very strong in emerging economies and Europe, and Anheuser-Busch was very strong in the North American market. So why don't we just get together? SAB Miller, SAB South African breweries originally, very strong emerging economies. Miller, very strong in the North American advanced economy. Let's put them together. There is complementarity in markets. Is going to be good for the two of us. In other cases, conglomerate, there isn't really any kind of, if you want, a strategic benefit of putting things together, other than, well, there might be good to just have a large diversified portfolio because I am able to, if you want, manage the finance and manage the flow of managers to companies that can be improved, and you end up with lots of unrelated activities. Berkshire Hathaway, big investor. It's not only a big investor in the stock market with small stakes in lots of companies, but also they also own complete companies. They are the whole owners of lots of very large companies, which are really unrelated to one another, but they happen to be able to give them the funds to grow and the managers that will improve those firms. So these are the different types of acquisitions that we can have. With this, why do you want to buy a company? Well, to some extent, two main motives. I can use what is already there, and I can basically achieve some level of economies of scale. It's in many cases, it's a story of more than just the economy of a scale. It's a story of a monopolization. Can I achieve the control that will enable me to lower those costs over time? Or alternatively, well, I need to learn this an innovation story. Can I basically renew the way in which I do things? Why is the leveraging story more a story of monopoly? Mostly because the idea here is that if scale is just the only story, yes, big is better, but it's mostly a story of not only just reducing costs, but also trying to be more efficient than others. And this is in many cases achieved through the reduction of competition that comes from buying other competitors. If we have two companies, yes, the joint company is going to be better than, not necessarily because you still have to operate different factories unless everything can be done in one single factory. You still are going to, yeah, so we're going to merge the marketing operations and we are going to get rid of half of them. It doesn't work that way because now the company is going to be much bigger. You need a much bigger marketing team. So the idea that there is some, if you want, redundant costs is not working out. The way to benefit from acquisitions is to some extent with a degree of monopolization. Alternatively, the other way of benefiting from acquisitions is learning and improving, and it wasn't working that well. All of a sudden, I get some, if you want, innovation technologies, I can improve it. Of course, the question is always, is there an alternative way of doing things? Why? Because acquisitions are costly. There is always going to be, for the most part, a payment of a premium. Can I run things better, more efficiently? Can I reduce the costs, or can I improve my operations to the point at which they are so much better that the premium I have to pay to buy the company, because sellers are not willing unless they're being given an additional money. Can I achieve the efficiencies or effectiveness so that I can basically get that money back? This is one of the biggest challenges with acquisitions. Can you recover the premium? Under which conditions you can recover the premium? This is the story. Monopoly power is a big concern for the government, and that's why there is antitrust. But the counter is this is in many cases the way to basically be able to recover that premium that is being paid. And then, of course, there is the extension, the learning, the going into other places with, again, the story is, can you recover the premium? Of course, success. Are we successful? Can we recover the premium? And this is always the question. For the acquirer, can we create more value from this acquisition by getting another company and controlling it than the value that was being created before? Typically, very difficult. Nevertheless, of course, the target is more than happy. Look, if you're overpaying for this particular operation because you are unable to obtain more value, I capture a lot of the value that you were expecting to capture. It can be very successful. So the idea of 80% of acquisitions are unsuccessful, the question is for whom? You can argue that, well, they are going to be very successful for the target that gets acquired by somebody who is overpaying for them. So there is all these subtleties to think about in terms of acquisitions. So let's go into the process. Being strategic about it, what do you want to achieve? Why do you want to get into acquisitions? Remember, acquisitions are an alternative to other methods for achieving, if you want, improvements in ability to create value. You can get into alliances, innovation, entrepreneurship. This is one among others. What is objective? What do you need? What do I really need? Well, the others are not going to work. I need to get into an acquisition. Okay, what are the different options? What are the targets? Are they amenable to being acquired? If not, how much do we have to pay for them? And this is the biggest thing, which is how do I value the company? How much is this company going to add to me? And the story is the value that I can potentially create and how much do I have to pay for this? There is a premium there. Am I going to be able to recover that or not? Can I realize this? Because it's not only that I do understand the target, I really like this. This is going to be nice to integrate, but then can I really integrate this? Which is one of the biggest challenges of acquisitions, because of course, these are companies that are operating differently. They have different histories, different practices, different ways of doing things. The corporate culture is completely different as well. Maybe I'm buying a company and there is some overlap in operations, so I don't really need to have three factories next to each other. Maybe one is going to be sufficient. There is always a challenge of if I close the two factories, well, that's going to be a big cost, both in terms of the closure of the asset and the sale of the assets, and also all the people associated with them. I'm going to lose their knowledge. There is a much more complex thing to think about. So always think, if you want to strategically, what do I want to get out of this? Is this the right company? Is this the right target? Can I get the company integrated in a way in which everything, the negotiation is done well, the company is well valued, and I'm able to capture potentially some of the value rather than giving all the value that is created to the target, and then can I integrate it well? This is if you want the long process. And of course, mentioning this story of business valuation, how do we value a company? Many different ways, lots of analysis of information. If you want a simple, or the simplest one is the market. If the company is publicly traded, hey, there is a market capitalization. There is an expectation that this company is going to create all this value in the future. So to some extent, that's, if you want, the minimum that shareholders are going to say that they want to be compensated for to sell the company. And of course, I have to pay something. How much am I willing to pay for that particular company? If I go all the way to my maximum, we're back to the challenge. Am I going to create any value? Well, I just gave all my value to the seller. Why am I getting into this? This is a story of thinking always in acquisitions, the premium. How can I extract additional value beyond the premium I paid? With market capitalizations or companies in the stock market, it's slightly simpler. Most companies, the vast majority of companies, are not publicly traded. They are private companies. How do I value them? Well, let's get into how much money are they making as an ongoing company. And then add multipliers. Many of them are industry specific. Think about, well, this is how much they are selling by year, so maybe the appropriate one is twice what they're selling. In some cases, it is, well, it's the operating income, maybe 3 times. It's the cash flow that we are really interested, 5 times. Discounted cash flows, which we tend to analyze in detail in finance. Yes, this is nice, but this is expectations of the future. Can we really predict the future? But nevertheless, of course, by all means, try to make models in which there is some understanding of what is going to happen to the company. If this is an ongoing company, we have an understanding of the past. Can we basically extrapolate towards the future? And can we give this a valuation? And in some cases, it's not something that works well. Maybe they don't really have much of a revenue sale. What they have is big potential. They have a new patent, new technology. So maybe it's the assets that we are going to get with, again, all the caveats that come associated with what are the assets that they have, minus liabilities. How do we value those assets, especially when they are intangible assets, technologies, reputation, things like this. And everything doesn't work is basically, if I happen to sell this company, how much will I get for this? But again, all of this is both an understanding of valuation and trying to see this as one way of this company under my control, how much value is it going to create? And if this is all the values it's going to create, I expect to create under my control, not others. All of this is specific to me. Can I pay below that? If I'm going to pay above the value I can create, I'm basically destroying value for myself. Maybe it's better to just leave it as an ongoing concern. So with this, lessons, acquisitions. What is an acquisition? You are buying another company, or 2 companies get together and they become a single entity. With these different types, friendly versus hostile, horizontal and vertical, product and market extensions versus conglomerate. But the thing always to think about is how do you want to use this acquisition? Is it something that you're trying to leverage your business model? It's a story of cost reduction, economies of scale, mostly a monopolization story. Or are we learning? Is there reinventing the business model? Are we going to increase the revenues? Is the learning story innovation? And then I can eventually do things better. And with this, the process. Why do I want to get into acquisitions? What is the logic? What is it going to help me achieve? Is this the right method to use? Remember, this is in comparison to alliances, entrepreneurship, innovation. Can I achieve the same objective? Okay, this is the easier, faster. Let's go for it. So this is going to fit my strategy. What are the different targets? How can I negotiate with them? Can I basically value them well? And then especially, can I integrate them? And this is the challenge of the getting into acquisitions, always thinking about you pay a premium, what are you going to do better than before so that you can recover the premium that you paid and basically capture value from getting into an acquisition. That's all. Thank you very much.